So a question that a lot of people have been asking me is, how does Jerome Powell's speech at Jackson Hole affect developing or emerging countries? Now, in order to answer that question, I'm first going to just paint a little bit of a picture of the problems that emerging countries are facing right now. And then we can look at what effect the speech as well as increased interest rates in the US will have on these countries. So at the moment, a lot of these developing and emerging countries, the problems that they are experiencing is obviously that they don't have a very strong economy. They've got a very weak economy. That's purely because the standard of living is not very high. There's not a lot of, the general population isn't living at a high degree, so there's not a lot of savings account, not a lot of cash in the consumer sector. So if there's any shock waves or problems that arise, the economy instantly takes a toll. There's no reserves sort of sitting with the consumers. They're usually dealing with very high inflation rates, unemployment rates. Their currency is also quite weak. They're not stronger than your major currencies. They need to have high interest rates. So the interest rates usually is high purely to attract investment. They want foreign investors to basically assist them by borrowing the money. So the result is that they usually are quite in debt. And in order to, so obviously, as we've just seen, because it's a developing and a emerging country, it is a risky investment. Sometimes it's the political system is corrupt, the political system is unstable. Obviously, these countries already are in debt, so it is risky. So in order to make it attractive for investors, these countries basically hike their interest rates quite high so that it justifies the risk. As they always say, there's always a return on the risk. So it depends on if you get high returns and the risk is high, it's sort of fine. But if there's high risk and no returns, then it's a hard no. So it's all about that balance. That balance sort of determines everything. How much foreign investors are willing to risk for what gains. That actually has a massive influence on what the interest rate change in the US has on developing and emerging economies. And obviously all these problems that these developing and emerging countries are having have just been amplified by COVID. COVID had just made everything so much more difficult. So if the US decides to hike interest rates, so obviously now with Jerome Powell's speech, we've learned that there's going to be a significant hike and it's not going to stop anytime soon. So it's sort of, basically what that means is going to means that fixed income investments in the US, and this is like your bonds, notes, your T-bills, those kind of things will have much higher yields. And the things with bonds, notes, T-bills in the US is it's very safe. It's actually at the moment, as we sit now, it's one of the safest investments you can make. Obviously, you can probably buy gold, but gold's not really an investment. It's more of a store of value. Whereas a bond or a note or a bill in the US is ridiculously attractive because now it's going to have a good return on investment and it's very safe because you basically have the US government that guarantees that you will get your return on investment. And it's a fixed investment. It's not like stocks where you might not get anything in 2 months. You will get your money back. So this is what the big investors see. So they see, oh, we don't actually have to invest in the developing and emerging countries anymore, where the high interest rates are. We can just take our money out there and we can just put it in the US. And we get exactly the same interest rate and or return on investment, but a lot safer. So what this basically does is it's this movement of money flowing from the developing countries into the US. So what that basically means is there's a demand for US dollars, because in order to have an investment in the US, you first have to purchase US dollars, and then you can invest in the US. And obviously, if you sell whatever assets you have in the developing or emerging countries, if you sell those assets, you obviously get their currency, whatever their currency is. You get that currency. You need to convert that currency to dollars. So when you do that conversion, it actually creates an oversupply of that currency, because you need to get rid of the currency. You don't want it. Which means that that country that you are selling your assets in, the developing or the emerging country, that country now, their currency devalues, which basically means they now suddenly experience inflation. So interest rate hikes in the US causes inflation in developing countries, because the US suddenly becomes so much more attractive. So that's a big changing, sort of a big twist of the equilibrium of where the big money flows in the world actually goes. So a lot of money is now going to flow suddenly into the US. So another thing that will happen is obviously the inside the US, the consumers inside the US, obviously they've got a lot of buying power, because obviously they're sitting on the world's reserve currency. The average income in the US is good. Things are actually very, very, very good in the US, despite what they think. It's very bad in the rest of the world, but the US basically, at the moment, they import roughly $300 billion a month. That's what they import from other countries all over the world. So, but if the consumer in the US starts struggling because of the interest rate hikes, they will automatically buy less. They'll still buy your staples. So staples are your stuff that you have to buy every month. Your electricity, your food, your fuel, etc., etc. Those are your staples. They still have to buy those. But the opposite of staples is discretionary. Your discretionary items is the stuff you want to buy. That is your iPhones and your fancy cars and all the nice things to have. So they'll purchase less of that. So whichever countries obviously supply those things, the discretionary stuff, they're going to suffer, because the US is going to import less. So that's the second sort of the double whammy, if you want to call it that the US will basically cause in these developing countries. So these developing countries will, one, they will earn less, and two, they will actually experience increase in inflation in their own currency. Now the problem that they have now is that because their own currency is worth less, they're going to obviously experience price hikes in their staples. Their fuel prices are going to go up. Any food that they import from other countries, those prices will go up. Prices of electricity generally goes up, because there's a lot of stuff involved in generating electricity, especially if you're still on the older systems, the non-green systems. And obviously your discretionary items will also go up, like your electronics. Those have a little bit less of an effect, but it still has an effect. So basically any goods that an emerging or a developing country imports from a stronger economy, those prices will go up substantially. The question now is, what do these developing and emerging countries do as a response? So they obviously want to control this. So in order to control this, what they do is they usually hike their own interest rates, because now they have to do it for two reasons. They have to, first of all, control inflation, and second of all, they need to make their country more attractive to investors. So the risk versus reward for the US is really good. So they need to beat that. So what they do is offer increased risk, but with increased reward, so that investors will still buy from the developing countries. But obviously this has a knock-on effect now inside those countries. So they already have a struggling economy. They already have all these problems we just spoke about. So now what happens is that the population obviously starts struggling. So the conditions in the country gets a lot worse. Because of these interest rate hikes, debt becomes more expensive. So a lot of people start defaulting on their debt. So if you are in a developing country and you are seeing these interest rate hikes, make sure you are either settling as much debt as you can, and also not creating new debt. That's very important, because that's where you're going to see it. And this obviously also, it becomes very, very risky. I mean, if we can look at Sri Lanka and Pakistan, Sri Lanka has basically completely collapsed. Pakistan is on the brink. They probably will collapse soon as well. And it's basically exactly because of these reasons. I know that there is some political influences as well. There has been a lot of corruption. There's a lot of political problems that also cause this. But the interest rate hikes they've experienced in the last 6 months was basically like the needle on the camel's back that just broke everything. I mean, they've hiked interest rates in 6 months. They did a 10% interest rate hike. That is 1,000 basis points. That's how much they hiked in 6 months. And the whole world is freaking out if the US hikes like 75 basis points in like 3 months. So yeah, just to give you an idea, Sri Lanka has also experienced, their current inflation rate is 60%. So this is basically what we will see. We'll see more and more and more of these things. Unfortunately for Sri Lanka and Pakistan, it will probably get much worse if they don't get relief from the IMF. But a lot more countries will follow exactly the same path. This is what is happening. But it's not all doom and gloom. There are some countries, unfortunately not all of them, but there are some countries that are emerging and developing that will not get it as bad. And these are countries that obviously has a large number of exports to the US that are staple-based exports. So like food and anything that people have to buy. And also countries with a good trading balance. So for South Africa, for instance, my home country, we might not actually experience it as bad. That's purely because our trading balance is really good. At the moment, the reason it's good is because the price of metals and minerals are very high, and majority of our exports are metals and minerals. So provided we can keep the mines going. A lot of mines have shut down, basically mostly because of unions and troubles with salaries and stuff like that. So if everything would just stay as is, we should be okay. We might not be great, but we might be okay. So we might not have a collapsing economy in South Africa, but unfortunately, it's not going to be the same for other developing and emerging economies. But yeah, that's the world we live in. It's interesting how a speech in a small little town called Jackson Hole in the mountains of America can just cause havoc all over the world. It can shut down economies. It can influence the lives of billions of people. Just one speech. It was 10 minutes long. So yeah, it's an interesting time to be alive. But anyway, if you like this video, remember to press the button. And if you want to see more, please remember to subscribe. Until next time, this is Steve. Ciao.